Don't do this, please. Hey everyone, and welcome back to the channel. I hope you guys are having a great week. Today is going to be the second installment of terrible, awful, ridiculous investing advice that you see on TikTok. There are so many of these videos. I could do a whole channel dedicated to looking at these videos. I won't be doing that, but you can get one of these maybe once every couple of weeks. So hopefully today is entertaining, but I'm also going to go through and explain what is wrong with these videos, as well as the way that you should be approaching investing under Warren Buffett's value investing principles, which is what I talk about on this channel. Also, I am likely going to be sprinkling these kinds of videos throughout the year occasionally. So if you do find any ridiculous investing videos on TikTok, make sure you send them in to me. You can send them via email, or probably the easiest place is to go over to Instagram. Follow me at Hamish Hodder Official, and you can just send me a DM if you have any ridiculous videos, and then they may pop up in the next months or the next video that I do in a couple of weeks. But with all that said, if you do enjoy today's video, make sure you leave a like on it. Let me know your thoughts down in the comment section below. With that said, let's jump into the first video. Oh, and one more thing. Some of these videos have copyrighted music, so I'll have to dim the audio a little bit and just kind of explain what is going on, but most of them have original audio, so we'll be able to listen to the full glory of these great investing videos. But the first video we've got here comes from somebody called Reality Check 2021, 2021, I guess. Okay, so this guy's just basically saying don't invest in any stocks because the market's very volatile. There's been a 30% drop, so this was in March. Okay, you should have no stocks. You should be 100% invested in gold. Right. Okay, so this video was basically made in March of 2020, right after the stock market fell about 30% in 2 weeks. And in this video, he's basically saying, what stocks should you own? You should own no stocks. You should be selling out of all of your stocks. This is after a 30% drop that happened in March. And you should be investing in gold because big fund managers are doing so. And then he says, if you don't know what you're doing, don't dabble in options, as if dabbling in options is something you do once you understand the markets. And he just says, basically, you should be buying gold because as the economy collapses, people will rush to gold as a store of value. And there's a lot wrong with this video, but let's just start with the first thing he said, which is that you should be selling out of all of your stocks. That is always going to be terrible advice. There is never a situation where you should be trying to time the market, figuring out where the bottom is, or the fact that the market's going to continue falling and just getting completely out of stocks. That is an insane strategy. And what's even more insane is to do it after the prices of those stocks have fallen 30%. If you're so good at predicting where the top of the market is and the bottom of the market is and getting in and out, why would you wait for the market to fall 30% before then getting out? If you're so good, you should have been able to predict when the markets when the markets had not yet fallen. What you should be doing with your businesses in your portfolio, the stocks in your portfolio, is analyzing them. If you have individual businesses, come up with a projection of what the future cash flows of those businesses are likely to be. And then you can make your judgments as to whether to buy or sell those stocks based on what you're expecting to get back from those businesses in the future. Who cares what the market's going to do over the next 6 months, over the next year? It will have absolutely zero impact on a really solid business that has distinct advantages, run by a great management team, and that has prospects to grow over the next decade and beyond. Personally, even after the 30+% drop that happened in March of 2020, I still felt as though most businesses were too expensive for me to want to invest in them. So in that way, we kind of align, but I was certainly able to find find some businesses that had share prices go down much further than 30 to 40%, which is what the broad market did. There were businesses in the travel industry, in the restaurant industry, in the entertainment industry, which saw 80 to 90% drops in their share prices, even if the business underlying was really, really solid. Even if the business had very low debt and was very likely going to come back to life, come back to where they were previously after the pandemic had gone away. And even if you're not investing in individual businesses, which does take quite a lot of analysis and research and time to find really great investments, even if you don't want to do any of that and you're just index fund investing, you still should not be thinking about trying to get in and out of the market. If you're just investing broadly in the US market, look at what the US market has done over the past 150 years. It has had dips, but it goes up as businesses become more productive as a group over time. Of course, individual businesses will do poorly, some will do good, but as a group, the biggest 500 companies in the US, the S&P 500, has gone up over time for over a century. So as a result, the best strategy for you is just to consistently contribute to it. If the market's down 30%, that's great. That means you can invest at a lower price. If it goes even further, that's great. You can invest at even a lower price. And you should just be consistently adding over time, recognizing that even though a 30 or 40% drop is dramatic, over the long term, that will be rectified. That businesses will repair themselves, the pandemic will go away, and businesses will continue to grow as a group as they have historically. In terms of investing in gold, I personally don't do it because I like assets that produce cash, because assets that produce cash can be valued. You can compare the price you're paying to something. There's something to compare it to. When a business produces profit and delivers that profit to you in the form of dividends and share price appreciation, then you can compare a projection of that to the price you're paying and see if that is a good relationship. You can't do the same thing for gold. However, to be fair, in 2020, gold did perform quite well, as it typically does, as people kind of rush towards it as a store of value, as a safe haven when other assets are not doing very well. But that's kind of investing in something based on market behavior rather than something investing based on intrinsic value, which is something that I personally don't do.
Part 2, chocolates. Let's go. I'm gonna give you 3 tips you need to know. Tip number 1, when you put all of your investment funds in the stock market, that does not mean you have all your eggs in one basket. The stock market consists of many industries. Examples: banking industry, healthcare, real estate, Nestle, food. Different industries have their ups and downs at different times. Imagine these chocolates were stocks. Stock 1, real estate, very down, not doing good. Stock 2, banking, doing okay. Stock 3, healthcare, very good. Buy this, maybe do not buy. If you had this already, sell it. If you have this, wait on it. If you don't have this, buy this now.
Yeah. The idea behind this video is on the right track. It's just not accurate in any way, shape, or form. To tackle the first thing, that if a stock that you hold is down, that you should just immediately be buying more of that. And if a stock is up, that you should be selling that. And if a stock has not really moved, you should hold on to it. Again, it's in the right direction, but it's just not accurate. What you really should be doing is comparing, as I said before, the price that you're paying for that business. So what is the market offering you? Maybe it's 30% less, maybe it's 30% more. Comparing that price to your estimate of future cash flows. Because while it can be the case that if a stock falls, its price is now attractive and you would want to invest in that business, it can also be the case that a stock is so overvalued that even if it is falling from being way overvalued to just now less overvalued, but still too expensive to make a good return. And the same is true on the upside. While it can be the case that if a stock's price goes up 50% or goes up 30%, that it is no longer at an attractive price or that it's now overvalued and you want to sell that investment, it can also be the case that a business is very, very undervalued, has gone up 30%, and is not as undervalued, but is still offering a very good long-term rate of return. So it is not enough just to look at your portfolio, see what's down, buy that, and see what's up and sell that.
Deposits from the government, but like most Americans, I'm in a lot of credit card debt. So I'm going to see how much I can make by learning how to swing trade on Robinhood. Before COVID-19 hit, I was profiting nearly $300 on the app alone. Then the virus came and I lost pretty much that same amount. Now that stocks are seeing some of their lowest prices, it's the perfect time to invest. I don't know why I decided to put my glasses on. If you never traded stocks before, Robinhood is a really good place to start. It's free and they don't take money on your trades. So yeah, I'm going to try to pay off my credit card this way. If you use my referral link, we both get a free stock.
Don't do this, please. First of all, swing trading, sometimes you'll win, sometimes you'll lose. Overall, you're probably going to lose because what happens to a stock in the short term is not something that is consistently predictable over time. Okay? News can come out, someone can invest in the company, someone could sell the company, a fund could buy the company, a fund could sell the company. What happens to a stock's price in the short term is not predictable, and it's not something that you should try and mess around with. Even if you have a really good reason to believe that a business's stock price is, that a business, for example, is going to report really good profits and good revenues at their next quarterly earnings, there are cases where a business beats expectations and the stock still falls, even the Wall Street expectations. So there is absolutely no reason why you should be trying to swing trade. But I don't even think that is the worst part of this video. The worst part of this video is trying to trade stocks in order to generate income to pay off your credit card debt. That is just the worst thing I've ever heard. Don't do that. A much better strategy is to find a stable income source, such as a typical job, and set a percentage of that money aside and just pay off the credit card debt. And the amazing thing about paying down credit card debt is if that credit card has 28% interest, 22% interest, 15% interest. As you pay that credit card debt off, you're instantly making the return of the interest rate because you no longer need to pay interest on that portion of the debt. So you're immediately making probably somewhere between a 20 and a 30% return, which is far higher than you should reasonably expect to get out of the stock market over the long term. So rather than trading in and out of stocks and trying to target some ridiculous return like 100% a month, that's just not going to be sustainable. You might do it once. Every gambler gets lucky at least once, right? But you're not going to be able to do that sustainably over time. It makes much more sense just to pay off the credit card debt through a job and then invest long-term once the credit card debt is paid off. That's the other important thing here to remember, right? If we're expecting to make somewhere between a 10 and 15% long-term return in the stock market, then there's no reason at all to invest in the stock market if you have credit card debt. Because as I said, you're instantly making or saving between a 20 and a 30% return just by paying down that debt, which is far higher than you should expect to get out of the stock market, which means you should just pay off that debt. Don't try and trade to pay off the debt, and certainly do not trade or invest in businesses while you have high interest credit card debt.
Let me show you why I wait to add to a stock when the market crashes. Let's take a look at some individual stocks. Let's take a look at Apple here. Apple's pretty popular these days. So yesterday, the market had a huge red day, which was right here for Apple. And I know a lot of people started pouring money into Apple right here. Which if you're holding this long term, I have no problems with that. But if you're really wanting to maximize your profits, it's better just to wait a little bit longer. Wait until what? Well, you wait for this downward movement to slow down. And what you'll see a lot of the times is this downward movement will be slowed down by previous support areas. So what I typically do is wait for this to find some kind of support, stop, slow down, and kind of do one of these and start to go sideways just a little bit. And the moment I see that sideways movement, I add small chunks.
And then what happens tomorrow? What happens if the stock goes down tomorrow? What does waiting for 5 minutes of a stock going a little bit sideways, what is that going to achieve for you? What, you save 0.5% maybe on that day. If you're holding that business over the long term, which you should be, because in the short term anything can happen, then that is going to make absolutely no difference to your long-term return in the business, which means why would you even waste your time doing it?
Support, breakout, new resistance, at a Fibonacci 61 retracement level.
This has got to be probably the number one video I've seen so far. This video is just so great. For a couple of reasons. One is it's supposed to be a lesson in technical trading, support and resistance, and Apple had broken through the resistance, which is now a support level, and that is an indication to sell Apple. The best thing about this video is that it was made in April of 2020. So let's go have a look and see what happened to Apple stock after this, because of course, you know, it had a new resistance level. That meant that the stock must have gone down after that. Okay, so this video was made on the 16th of April when the stock price was $71. Since then, the stock is up 84%. And there wasn't really any period where the stock actually dipped substantially except immediately after that. And look, I don't know if an 84% increase in Apple stock price in 2020 was justified. I don't know if the value of the business increased that much. I don't know if it was very undervalued and now it's back to being fairly valued. I haven't looked at it very closely in the recent term. But what I do know is that using technicals to get out of a really great business is often a terrible idea. In some circumstances, it will work. In some circumstances, you will do your technical analysis. You will see that, oh, there's this new resistance. Its price won't go above this, and you'll sell the stock, and it'll work. And sometimes it won't. And to me, that's not really a good strategy. I would much rather just look at the underlying business, not care about what the stock's going to do in the next few months or even over the next year, estimate the future cash flows of that business, and come up with a reasonable expectation of what I can get back from this business. What return am I likely going to make if Apple grows at 8% per year? If they grow their iPhone sales at 8%, if they grow their services at 12% per year? Come up with a projection of the underlying business, because that is where the stock price goes over the long term. In the short term, anything can happen. But this video is just hilarious to me because the stock went up so much right after this guy's video. And it just shows that this guy has no idea what he's talking about, and the method that he was using in order to determine that you should sell Apple clearly doesn't work. But that is all the videos that we had time for today. I hope you guys got some entertainment and some education out of today's video. I'd love to hear your thoughts down in the comment section below. And of course, if you want to see more content like this, then make sure you hit that subscribe button. But other than that, I hope you guys have a great day, and I'll see you in the next video.